Welcome to Investors Guide and thank you for tuning in. We are going to, over the next half an hour, try and tackle as many questions as we can. And we'll try and work faster this week because Dhirendra happens to be in the studio in Mumbai. Dhirendra, it's a pleasure to have you in Mumbai. I want to just go through what we're doing for this week with our viewers. We'll start off by helping an investor earn a regular income post-retirement. We take a look at the Tata Large Cap Fund this week and we'll tell you if it makes sense to switch out your home loan for a lower interest rate. Before we start answering questions, Dhirendra, obviously one of the things that most investors would either be bragging about this week or feeling like they missed an opportunity was the DMart IPO listing. And we haven't actually had a big bang IPO list in our market for a very long time. Most of them wait for the right opportunity. 115% return on day one. And we keep telling our investors and our viewers to avoid these sort of investments. So there will be a few people who are turning around and saying, did I miss out on a massive opportunity because we take the advice of this show? What's your response to those who missed out on the DMart IPO because they took our advice?
No, we did not actively advise that don't invest in IPO, but it does not fit in with your plan. We earn every month, we spend every month, we are left with some money every month, and for most ordinary people would like to stick to a plan. Now, IPO, I think one has to look at the right context, that you must have, if you have a lot of money lying idle, and you were ready to appreciate that you will evaluate each and every IPO, avoid the duds, go with the winner, and then there is an element of lottery. Element of lottery on two counts. One is that, did you get the allotment?
Yes.
How many people got the allotment? And in fact, the lottery element, lower the probability, the higher the likelihood of substantial listing gain, because there is an immediate demand and there is an appetite, and not too many people are did not get an allotment, and there might be an appetite. But I think one should be looking at what this IPO, it definitely is a standout IPO, and this looks like a standout company. And it looks like, we have very limited, small number of standout companies. Whether you take it from an IPO standpoint or even from the listed universe, you still come across companies like Asian Paints. You still come across companies like HDFC Bank.
Yes.
They always command a premium, and they have been able to sustain that over a period of time. This looks like a promising one. Because all the other in the same category, they have been struggling businesses, or they actually have.
Do you expect this 640 sort of price that it's all listing to at least continue for the short term, or do you expect it to, like a lot of the other IPOs that we've seen, sort of taper off as the general interest comes down in the stock?
It can well sustain. Okay. And in fact, investors should hold on to this stock only if they think that in next 3 years the stock price will double and they will have the numbers to justify that doubling. And that is a possibility which can't be ruled out, because that is the quality, that is the nature of the business, or the people who are managing it. They're focused on something very basic, simple, doing it differently, and doing it differently and with a demonstrated capability. So, they have, I was reading it very closely, the qualitative aspect of running this business, that all others are struggling, they have a 4.5% margin. Run with great, simple principles of running the business, of retailing. And then, demonstrated ability of growth in a situation, in an environment where, the growth potential can still be enormous. And this is, when people are looking for credible promoters with track record, with background, this has all of it in an IPO.
Right. And for those of our viewers who are purely mutual fund investors at this point, how do they get a slice of this sort of action? If at all, do you recommend that they add these stocks to their portfolios? Or do you think that just staying in mutual funds, following advice of doing SIPs is enough? I shouldn't feel bad when an opportunity like this comes and goes in the market. No,
in fact, if investors feel bad about it, then they should do something urgently to address that need. They should make a fund allocation in their portfolio.
Right.
If you are doing 25,000 rupee SIP, don't disturb it. But take out some from somewhere, 2 lakh rupees, and let it sit in a liquid fund. And wait for it. Wait for your opportunity. Wait for such, so that your overall plan doesn't get derailed. But whenever you and have this fund allocation, and you can do any kind of fund, sometimes, and you can do it methodically.
Yes.
And if your fund allocation is able to demonstrate to yourself that you are able to do a great job, maybe over a period of time, 5 years from now, move all the money that you have built with mutual fund to yourself, because you are turning out to be a better one. And if this fund allocation becomes disappointing, or if you don't have the discipline to to stay put with it, you are unable to sustain your own accumulation over time. You actually you invest in you get lucky with this IPO and you see the money, realize it, go on a holiday, then keep your fund allocation as the fund allocation and have fun.
All right, so that's very, very clear advice. If you are the kind of investor that wants to desperately invest in IPOs and in stocks, then make sure that you're the kind of person who can do all of the homework and dedicate that kind of time, and who's willing to take the risk. Now, while this particular IPO has been a blockbuster, not all IPOs are blockbusters, and you have to be able to tell the difference. The best thing to do is to continue to invest in your mutual funds through SIPs. And Dhirendra is saying, if there is an itch and you really want to take part in the fun, then set aside a small amount of money that you don't mind taking a risk on, and that's your fund allocation. 39-year-old Sanjay has written in. He tells us, a beautiful 4-year-old daughter whom he wants to save for 20 lakh rupees for her wedding and 20 lakh rupees for her higher education. He wants to get rid of his home loan with the next 8 or 9 years. Now, he takes about 1 lakh home in his salary every month. He has a home loan and he's currently paying rent. He's going to move into his own home in 4 months. He has a daughter, like he tells us, who is 4 years old. He has an LIC term insurance plan. He has parents staying in a different state and he's sending them money every month. And his wife is a homemaker who has personal expenses about 5,000 rupees. He says, of course, he's begun an investment in the Sukanya Samriddhi Yojana of about 60,000 rupees this year. He has medical insurance and he has not started investing in mutual funds. Now, the Sukanya Samriddhi, again, is a plan that a lot of people have taken, the ones who have young children. It does make sense because it offers a preferential interest rate. But do you recommend that a lot of parents add that plan to their portfolios?
Not really, who is sending us a question to get an answer.
Yes.
Because the whole idea is that, this is a very long-term investment for a very defined goal for the girl child to be taken when she attains majority. So for any child who is 5-7 year old, which means it's 10 years and more that you are going to invest, and that too regularly. This preferential, of course, it's 25 basis points more.
That small, you're saying incremental interest rate is actually not going to matter or not going to make a big difference. It's not meaningful
because, this is the kind of money with which you should be assuming risk. And it is actually not risk because the whole risk gets reduced when you are investing for 10 years and more. Regular investing 10 years and more, equity is not risky. The real problem is that if you watch it every day, you are investing for 10 years, but looking at the value every day and getting concerned, then it's a risk.
So tell me this, if I were to put money aside, and if he's talking about, he wants to put money for his daughter's wedding and she's 4 years old, we can safely assume he has 20 years on his hands.
Yes, yes.
What would be your assumption if he were to put money into an equity mutual fund for the next 20 years? What is your conservative assumption of return?
I would say that my expectation will be that at the least, with a conservative portfolio, I should be earning 1.5 times more than the fixed income. One thing which every investor should try and look at, that future is going to be very uncertain. Things are going to really change radically in the coming times, simply because everything is anchored to the inflation. If we are going to have very low inflation or zero inflation in future, then I'll be very happy with 4% deposit rates and 8% return on 8%, 10% return from equity might look very interesting. So what we have been used to is 20% return from Sensex and unmanaged index, or 20, 22%, 25% from well-managed fund over a 20-year period. That may all be past, that may all become history, but the future lower return may not be as disappointing, because most of your goals will be fulfilled even with lower return.
Here's what we're saying. Now, you've already put in the 60,000 rupees and you're going to put another 10,000 rupees if you haven't already in this Sukanya Samriddhi Yojana. That's a total of 70K. Just leave the 70K there. Dhirendra says that over the next 20 years, you'd be far better off moving that money into an equity mutual fund. Look at the difference. If you're looking at 8.25% from the Sukanya Samriddhi plan and you're looking at 13 12, 13, 14% conservatively from any equity mutual fund, then you'd be better off moving into the second option. He hasn't invested in mutual funds at all, Dhirendra.
Yeah.
How would you like him to get started? I don't want to push him too far because he's obviously someone who prefers fixed income. So how should he get started?
It's not a matter of pushing somebody into equity or not. It is a matter of need-based thing. If you are actually a conservative investor, approach your depending on your needs, approach it conservatively. So instead of investing in an equity fund, invest in a balanced fund. Have a disproportionately larger emergency fund. This itself will take care of it. Build your temperament into your plan. I'm not saying that build your portfolio with small caps and mid caps and take a very aggressive stance on the whole thing, or and the risk has to be reduced by conducting in a slightly more conservative way, like preparing for the disinvestment 5 years before you need the money. That I think is a greater insurance against approaching things conservatively than waiting for the last moment, or preparing too late 3 years before that. Instead of that, start preparing for it. Your disinvestment plan should begin 5 years before you need the money. So I think these are other ways of insulating yourself rather than being scared about it and being methodical about it. I think we are still missing one thing, that the experience of investors to stick through a full market cycle. I still don't come across too many investors. We are still in a rising market. A lot of investors started when the going was good. And people are sitting, are very pleased with the return that they have been able to derive. You will get bad times. In 24 years period, you will come across very lean period as well. And your ability to stick to your plan with investing regularly a certain part of your income, earmarked with discipline, with conviction, is not that easy.
All right, see, it's very simple. What you need to do is you need to hang on, keep the faith and invest in equity mutual funds. Dhirendra is saying that the risk comes down with every year you stay invested. So you have 20 years on your hand when you're talking about your daughter's future. And that's a nice long time. So go in through SIPs in a systematic way. When you're 5 years to your goal, so when your daughter's about 15 or 16, or if you want to pull the money out when she's 21, you need to start moving that money out of your mutual funds slowly in a systematic withdrawal plan and moving it into something fixed income so that you're not feeling any of the risk. Dhirendra, would you recommend our growth or our stable growth portfolio for this gentleman?
If it's conservative, I would like him to get started with stable growth portfolio and maybe 3 years from now move on to our growth portfolio. And that is a nice way of, getting on board.
Anil Kumar has written in, he wants to retire in a couple of months. His retirement corpus has 1.2 crore rupees in PF, 45 lakh rupees in superannuation, 35 lakh rupees in gratuity. He says he won't get a pension after he retires. He has to invest this money to generate a monthly income of 25,000 rupees a month. He also needs 1 lakh rupees a month post-retirement. He says he will use his PF to buy his own home. What should he do? Since he knows that he will need 1 lakh rupees a month, and that's obviously a non-negotiable, that's the lifestyle he has. Would you recommend that he give up perhaps on the need to own his own home? Rent out, and then that money that he then has available, the 1.2 crore rupees that he will be using to buy a home, if he uses that instead to generate an income, he'd actually be quite comfortable.
Yes, but his need for income actually might go up because of the rent. Yes. So I don't know, things should have been planned a little earlier. And maybe these are rough estimates. I think he should do because he should look at it as an emergency. That I don't know. There are a couple of combinations which are non-financials. One is that can he still work further, so that his need for income can be deferred by another 5 years. That can actually change the dynamics completely. Can he really think in terms of budgeting this 1 lakh, that this 1 lakh rupee is actually not 1 lakh but 65,000?
Yes.
Because if this is a rough estimate, it can actually get changed. Because our thumb rules are a very rough estimate of things. Things might change. And what are the kind of changes that will happen in retirement which can reduce or alter your expenses? Things change, and things will change dramatically. 5 years from now, 10 years from now, your health expenses and other things, and a lot of expenses will actually come down. And so he'll have to think more in his own context and look at the options.
All right, Mr. Kumar, unfortunately, we don't have good news for you today. Given the corpus that you have right now, although it might at this point when you're retiring seem like a lot of money, because normally when we work our salaried lives, we don't come in contact with this much money at any given point of time. But if you do buy your home with your PF amount, you will not have enough money to generate 1 lakh rupees a month as a take-home pension. You have to either relook at your expenses and spend less, or relook at your need to buy a home, unfortunately. Perhaps also, like Dhirendra says, relook at the budgeting that you will need to do after you retire to see if you can do something there, perhaps, to make the numbers add up a little better. So what we've learned in this segment before we take a break is to invest in equity if you're looking at something for the long term, especially for your children's future. And of course, stay on course. The market will reward you if you stay loyal to the cause. Dhirendra Kumar is in the studio with us in Mumbai. This week, we're looking at the Tata Large Cap Fund. Avan has the numbers. Avan?
Thanks, Faye. This week, we take a look at a large cap fund, the Tata Large Cap Fund. With just about 800 crores as assets under management and 3 stars on value research, we take a look at its performance over the last 5 years. The red line is the fund and the blue line, its benchmark. You'll see that the fund has performed better than the benchmark and the category in both the bull and bear phases of the market. In the year 2014, the fund's return was 36%. While the fund has consistently performed better than its benchmark, its returns are average when compared to its peers in both the long and the short term. In the last 1 year, while the fund gave a return of 17%, it was in the middle of the pack when compared to its peers. Even long-term returns show that the fund's returns when compared to its peers is just average. So should you invest in this fund if you're a new investor? Let's find out. With that, it's back to you, Faye.
All right, the Tata Large Cap Fund, like Avan is telling us, 3 stars on value research, and its return over the last few years has been middling. It has been average. And like you've pointed out several times on the show, there are better options right now for someone looking for a large cap fund. Would you recommend anyone still in this fund continue to hold on to it? Does it merit more time?
I like this fund despite its middling performance, simply because, it has stuck to its goal of, focused on the blue chip, create a portfolio of, fairly defined universe, 30-40 stocks, never get distracted. It is not never attempted to get into, the racy part of the large caps or doing any big moves there. It has been an average performer in the last 2 years, undoubtedly, slipped on the rankings relative to other funds. But this fund, despite its middling ratings as well, it has had an impact on the rating. But when I look at a large cap investor, his expectation is somewhat like a balanced fund that you are looking at a conservative take in a predictable way. This fund still actually looks impressive.
You would recommend those people who are invested in this fund to stay invested, but do you recommend any fresh investment?
Fresh investment, one can well consider it, because large caps generally has been out of favor. And of course there are other options too. There are more impressive alternatives in the large cap category as well.
What's your star rating for this fund?
Based on its performance, it is a middling one, but I will still slot it, based on my understanding of the fund, I will slot it a notch higher than its 3-star.
All right, so 4 stars then for the Tata Large Cap Fund here on Investors Guide. Dhirendra is saying it's a good fund to hold on to if you already have it in your portfolio. It's not a bad fund to add to your portfolio either, given the fact that large caps may come back into favor. I want to take one more question. This is an interesting one. Rajiv Kishore has written in. He says he took an ICICI home loan in 2013 at a floating rate of 10.2%. I think I know where this question is going. He says ever since 2013, the RBI has been reducing the repo rate, but ICICI Bank has not been reducing his floating rate. He says it is his charge now 9.85% per annum. When he approached the bank, they said pay 7,000 or 7,500 rupees as a charge to get your loan rate switched to a lower rate. He says, should he continue with the same bank or switch to another bank completely? I think the answer is obvious here, to switch. But my concern here is you're just going to be having to switch from bank to bank to bank, because they're all doing the same thing right now.
Yes, and first and foremost, I think you should demand demand this answer in writing. Make a request in writing and get the answer in writing. And also, if you pay 7,000 rupee and if you don't move your balances elsewhere, you will actually save yourself the hassle of doing the whole documentation, moving it to other places. If you are able to get a competitive, look at it as a one-time nuisance.
Yes.
Ideally, it should not have been there.
Yes.
But what to do? If 7,000 is the cost of getting a lower interest rate on a recurring basis for a long-term borrowing that you have done, go ahead with it. But before that, do these two things. Ask this in a formal way and check that, and this in itself will actually serve a purpose. Many a times, bankers ask for something which they can't really stand by, so they give up.
So what you need to do is, of course, consider what the total cost of a loan is, and the cost includes processing fees, it includes franking charges, any other charge you will have to pay when you get your loan refinanced by another bank. So basically, you take your business elsewhere, there is a charge in that as well. So first of all, it makes sense to shop around and find out what other banks are offering you. Are they better rates that they're giving you? Are they giving you, are they maybe waiving off the processing fees or the franking charges? Some of that is happening as well. It might make sense to take a look at that before you make your make up your mind. There will be a lot of paperwork to be done. Then they're saying once you have all of that information, then weigh in your options and see, does it make more sense to just pay the 7,000 rupees and move to the MCLR system, assuring yourself of a lower rate every time the RBI reduces the rate, or does it make sense to shift? That's unfortunately the decision that you are going to have to make, but we're here to advise you if you need any more help. SAWMYA Mukherjee has written in, Dhirendra. She wants 12 lakh rupees in 4 years' time for a down payment on her flat. She's been investing 7,000 rupees so far and can add another 15,000 rupees per month. These are the funds she has been investing in: the Mirae Asset Tax Saver, Access Long-Term Equity, the DSP BlackRock Tax Saver, the Birla Sun Life Tax Relief, the UTI Mid Cap, and the Kotak Select Focus, along with the SBI Magnum Multi-Cap. So obviously she's doing a very interesting thing, which is using her entire need to save taxes and combining it with the need to buy a home. Do you think she's on the right track?
Yeah, one should always avail the ATC entitlement that you have to the hilt. There's absolutely no point missing out on that, because you save tax, that is money earned, and then you are able to maximize your return by being in equity. And your time frame, of course, I'm a little unsure about the 4-year time frame, but this is a negotiable goal. 4 year, if it is not good enough, you can well wait, or a part of your money might remain there. 12 lakh rupees.
So two things might happen. She might find out in 4 years' time that she hasn't reached that target, so she has to wait another year. Or she might find out in 4 years' time the home that she was hoping to buy at 12 lakh rupees down payment is a lot cheaper, and she's able to buy it by then. So things might change.
No, I think she can only get lucky, because my sense is that 15,000 rupees in 7,000 rupee in monthly investment which she's doing now, if that gets increased to 15,000 rupee or additional 15,000 rupees a month, then this 12 lakh rupee is not a challenge at all after 4 years. She will have that because her own contribution, she herself will be saving nearly 8 lakh rupees over the next 4 years. So that's not a very significant, that's not a big target. The real thing is that she will have more than enough she will have more than 12 lakh rupees. Home prices coming down, that will be an added bonus. Which one to get out of at that time? And maybe, if she gets lucky, which one to get out, and be methodical about it and stick to the plan even thereafter. Because buying making the down payment for your home is not the end goal. Financial goals, you have to really reset your goals once you have achieved one. This might look like a priority right now. So then maybe, and she will have greater belief in this whole method of planning things, saving, investing, and achieving that goal and moving on.
All right. So that's the advice you're getting right now. We have to wrap up the show as we've run out of time. But a quick recap on everything Dhirendra has taught us in the last few minutes. Stay invested if you have the Tata Large Cap Fund in your portfolio. It's a good fund to have. All new investors can consider the Large Cap Fund, or there are other options that we've given you on the show. Also, remember that if you have to save on tax, that you must do that first before you do anything else, because every rupee that you save on tax is money earned. And if you're looking right now at a loan or the rate that is higher than what is being offered in the market, it does make sense to shop around and reduce your interest rate as quickly as possible, because what's happening every time you pay an EMI is that you're parting with money that you shouldn't have to part with, that could ideally go into your long-term savings and make you very rich over the long term. So every rupee there counts and should matter. That's a wrap on Investors Guide. Dhirendra, thank you so much for spending time with us. It's a pleasure to have you face-to-face here with us in the studio in Mumbai. Thank you for watching. You know how to get in touch with us. Both Dhirendra and I are on Twitter. Or if you need anything else, you can write us an email. Thanks for watching.